Muted? Hey, everyone, I think I was muted. So, listen, you don't want to miss tonight because tonight I am going over the Biden versus Trump tax plan. So, go ahead, share this video to somebody who you think who needs it. Listen, we have a big day tomorrow, election day. So, I want to make sure that you have this information ready for you. Like, make sure that you're ready, you're prepared just for whatever possible changes that can actually come your way. So please go ahead and log on, share, comment, let me know if you can actually hear me. I made sure to test all of this, and from what I know, everything seems to be working. So yes, it is good to see everybody on here. So go ahead and log on. Listen, I am super excited to share this information with you today. So, like I said, go ahead and log on. What I'm going to do is I'm going to make sure that it is coming up, and it is. So, yes. So, welcome. Go ahead, like, share, comment already, because we are going to go over some really, really good information. And so, as you all are doing that, what I am going to do is I am getting ready to share. I'm getting ready to share a PowerPoint because I know that we have some people that are very visual learners. And so I want to make sure that we are visual today. So just doing a little bit of testing right here. And what I am going to do is I am going to share a Chrome tab. So we are going to get ready and get started. So yes, you can definitely watch the replay. If you are watching this replay, go ahead and put hashtag replay. Go ahead and put hashtag replay. If you're live, go ahead and put hashtag live. Let me know where you're from, what city, what state you're from, and we will get this started. Listen, you are on the comma effect. And today we are going to see how this affects your commas, right? How this affects your numbers, how this affects your business. So I am super excited. Again, we are going to go ahead and get started. Let's go ahead and jump right in. What I'm going to do is I'm going to share my screen so that you can see everything what's going on, what we're going to talk about as far as the agenda. And I am definitely excited. So let me go ahead and present this to you. So what I wanted you all to see is the agenda for tonight. We're going to be doing an introduction. We're going to talk about the current tax plan. We're going to talk about how a tax law is actually passed. And we're going to look at the Trump tax plan and the Biden tax plan. And so let me talk about introduction and disclosure. Listen, this is not to be taken as professional advice for your situation. It is for informational purposes. Please consult with your tax professional regarding your particular situation. And so me being a CPA, it is important that that I have to go ahead and let you all know that yes, I am a CPA, but this situation is not necessarily like for your particular tax situation. So please know that. Don't take this as professional advice and try to be like, hey, Coach Janelle CPA told me to do this. So you want to make sure to get the information that you need so that you can apply it to your particular situation. I'm required to do that. And so also, the reason why I see that this is important, because we all know that taxes affect everyone. And let's just be real, right? You want to make sure to be prepared. You want to make sure that, for whatever circumstances, whatever tax plan that is getting ready to come, that you're prepared for that. And so a little bit of introduction. So let's, again, let me go ahead and say this. This information is not biased towards any party. Listen, again, this is for informational and educational purposes. So again, this is not to necessarily really just talk about one party or the other, but it is to prepare you, because listen, guess who's still going to be getting paid? The IRS, right? So no matter what side of the political spectrum that you're on, listen, the IRS is going to be like, listen, we are still going to deduct from your paycheck, and we're still going to get paid. So that's one thing that we know that is always going to happen. And so let me go ahead and go and share my screen. Going to go to these Google slides. Yes. So here right now, I'm just going to go ahead and dive right in so you guys can see the tax rates, right? So I want you guys to see these tax rates that we are currently on. What is this plan actually called, right? So this has been incorporated since 2017. We have single individuals, married, and head of household. I like everything to be in one spot so that you all could see which space that you actually come in at and what your tax rate is. And so you guys can sort of see where you fall on the income scale, right? So here we have 10%. This is for single individuals that earn up to $9,875. They get taxed at a 10% rate. This is based on your taxable income. So I'll go into a little bit of that. Here we have married individuals filing joint returns. So we have up to almost $20,000, right? And basically they get taxed at a 10%. And then we have head of household, which is kind of in the middle. And so as you go up, so basically we're on a marginal tax rate. So what does that mean? That means that up to, so let's just say, let me go ahead and talk about married individuals filing joint returns. So let's just say that my income level is $100,000, just to be on a safe math side. So the fact that me and, my husband, for example, we make $100,000. So that would mean that up to this income of $19,750, I'm taxed at 10%. But from $19,751 to $80,000, I'm taxed at 12%. So seeing that our income is $100,000, there's going to be a max amount here, which is 10% of this. If you guys are pretty good at math, you know that that's almost $2,000. And here, same thing. You're going to take $80,000, subtract $19,000, multiply by 12% to get the taxable amount. And then you have your 22%. So seeing that we fall under, for example, $100,000. Well, we're going to take the amount that we earn right here, subtract the $80,000, which gives us about $20,000. And we're going to multiply it by 22%. So overall, a lot of the what happened since 2017 is that our tax rates were reduced because these were a lot higher. And then seeing that those millionaires out there and those who have taxable income on a higher end, we see that we have, up to $326,000, you're taxed at a 24%, which is pretty good. And then on 32%, you need to be making about over $400,000, and then 35% if you're well over $500,000. And then if you're over $622,000, then basically you will be taxed at 37%, right? 37%, which is a lot. And so here's the thing. That was including the taxable income. We're looking at the tax deductions right here. And the tax deductions, once we look at this, is we're looking at single is $12,000. And this is for 2020. So this is directly straight from the IRS site. That if you're single, you get a deduction of $12,000 roughly. If you're married filing jointly, you get over a $24,000 deduction. And then if you're head of household, you get an $18,000 deduction basically. So why is that really good, right? So let me go ahead and stop right here and sort of give a, while we're here, let me know if you guys can see the screen and what I share. So let me know. I don't necessarily see lots of comments, but I know y'all are watching. So let me go ahead and talk about a little bit of the history of how this all came about. So basically, prior to this 2017 Tax Cuts and Jobs Act of 2017, basically, there used to be a deduction for single, married, head of household. And then for each dependent or child that we have, we were able to take something called an exemption. And so if we had 10 kids, right? If we had something like 10 kids, we would be able to multiply the amount of kids or dependents. Oh, you can't see the slides. Love it. Love it. Love it. Okay. So you weren't able to see the slides earlier. Man, I had that all nice and set up. So, okay, no wonder why I lost a few people there. I was really going in too. So, all right. So let's just talk about what actually happened with the 2017 Tax Cuts and Jobs Act. So basically, all in general, our tax rates were basically 10%, 12%, 22%. So the more income that you make, the more marginal taxes that you would have to pay. So, for instance, anywhere from $1 to $10,000, you would pay 10%. And so I do have the exact numbers on my slides, but guys can't see it, so that's fine. You would pay $1,000, and then if you're married filing jointly, if you had $80,000, you would take 80,000 minus, the $10,000, and you would have the marginal tax rates. Well, they were lower since 2017. And some of the things that happened with that is that there was an elimination of the exemption. So again, when we talk about tax rates and tax deductions, depending on what status you were, if you were single or married filing jointly, or if you were head of household, you were able to take additional exemptions of your dependents and your children. Well, what happened since 2017 is they said, listen, we don't care how many dependents you have, of course, unless it's the Child Tax Credit Act. But what we're going to do is we're just going to give you we're going to increase your tax deduction overall. So if you were single, you basically got a tax deduction of $12,000 off of your taxable income. And then if you were married filing jointly, you were able to deduct $24,000. So that was big. That was considered big, because what would happen is a lot of people who had lower deductions, they were able to itemize their taxes. And so the difference between standard deduction and itemized deduction is that a standard deduction was just a rate that the IRS gives you. The itemized deduction, you were able to deduct certain expenses so that you can reduce your taxable income, but it has to be one or the other. And so with the itemized deductions, you were able to deduct things like, mortgage interest. There were some limitations with that, medical and dental expenses, just depending on where they fall and what percentage of income. There was like a lot of requirements that you have to have in order to claim a deduction, an itemized deduction. And so what happened with that was that, which is great, how I see it is because and we're talking about the current tax plan, is because we were able just to do away with a lot of the paperwork, basically. So if you're married filing jointly, and if you didn't have itemized deductions, that means your church contributions and mortgage interest, if it wasn't more than $24,000, then guess what? You did not have to fill out Schedule A, which talked about, which has all of your itemized deductions on there. So that was a great thing. I'm gonna slow down since you guys can't see my slides. Another thing that was really helpful for those that are investors was something called a capital gains deductions tax. So what does this mean? What is capital gains, right? Let me slow it down. A capital gains is, let's just say that you buy stock or you buy some type of a rental property, right? And capital gains means that you typically hold on to that property, whether if it's a stock, a rental property, or it doesn't have to be a rental property or a house that you're flipping. If you hold on to it for more than a year, it's considered to be taxed at a capital gains. When is it taxed, right? So if I were to buy some stock, let's just say I bought it for $1,000, I held on it for a year. That means that when I sell it the next year, the tax rates, they have different tax rates than what we are currently paying. And so the good thing about the 2017 Tax Cuts and Jobs Act is the fact that there was, for some people, you only paid 15%. It was a 15% capital gains tax rate. If you were unmarried, $40,000. So if you had a $40,000 gain on a certain business property. Now, again, I'm talking about stocks. I'm talking about business property. So we're talking about business property, or $80,000 if you were married filing jointly. And then it went up to 20%. And so if it was a little bit above, of course, you would have to pay a little bit more, but the 20% tax rate went up to almost $500,000. So that means that if you made roughly around $400,000, you were only taxed at the 20% rate. Why is this important, right? Well, the reason why that's important is for those who have a little side hustle, right? For those who buy stock on the side, for those that are trying to generate income, you're taxed at a lower rate once you realize that profit. So that's capital gains tax rate. So that's what happened since 2017. I'm trying to give you the current picture of our tax landscape so you guys can sort of see what changes would be implemented and how the tax law process goes. And so we talked about capital gains rate. One of the other benefits that happen under the 2017 is something called qualified business income, QBI. So for those who have S corps, for those who have LLCs, for those who have different businesses, there are certain deductions, and I'll just say this in general. Again, it depends on your particular type of business. You are able to take a 20% deduction off of your business profits, right? So you're not taxed. You have a 20% deduction. And so those are for people who are S corps. Those are people who are LLCs. Those are people with sole proprietorship. So those who have a business were able to have a qualified business deduction of their income, right, of 20%. Another thing that happened under 2017 is the fact that the tax rate for corporate tax income went from 35%, for over 35%, 34%, right? It went all the way down to 21%. So if you are a C corporation, right? Big corporation, Walmart, right? Their tax rate went like from 33, 34% all the way down to 21%. And so that's why they were like, the S Corp, the smaller businesses said, hey, what about us? And that's why the QBI was actually the qualified business deduction was actually formed, right? So because they saw that the C Corps actually had a deduction in their tax rate, they were like, hey, what about us? And so that's some of the things too. And also, like I said, with that came some sacrifices of other things that couldn't be deducted for businesses. So if you guys notice, since 2018, if you were able to take your, let's say you wanted to take your client to go to a basketball game or for a cruise, or you wanted to entertain your client, you wouldn't be able to do that under this new current law with your business because it won't be counted as a business deduction. You can deduct 50% of meals, but there were certain things, certain limitations that there's some certain limitations for deductions on business. So again, the biggest one was like entertainment expenses, because if you had a lot of money, you were able to spend a lot of money on your prospective clients, and you were able to be entertained as well too. Well, basically you wouldn't be able to take that deduction. So that was one of the things. Also in itemized deductions, there were some limitations to certain amounts that you can actually deduct. So those were some of the things that happened under the 2017 Tax Cuts and Jobs Act. But let me tell you what's going to happen in the future. So these are set to expire around 2024, 2025. So the tax law as we know it is going to be set to expire the end of 2024 or the end of 2025. And even in the next couple of years, we're going to see some things expire as far as tax reductions and tax cuts. Those are starting to go away a little bit by a little bit, right? But it's from 2017 all the way to 2025, right? of whenever you can take those of those reductions, basically. And so I wanted you guys to have that. And so let me go into how tax laws are actually passed, right? So before I wanted to give you a current landscape again of the tax situation, but then also talk about how tax laws are passed, right? So one of the misconceptions that I feel as the public gets a lot of the times is the fact that, as soon as the president is able to come in, they're able to make changes to the tax law and it's a done deal, right? Well, we have a thing called checks and balances. And so how the tax laws get passed is a president, whoever's the president, can actually recommend a tax law policy change. And so it has to go through the House of Representatives and the Senate, and the Congress is actually the ones who pass the tax law, is the Congress. So whenever you say Congress passed this particular policy, Congress passed this, that means that it got passed, but it has to go through the proper procedures. And so not to elaborate too much on the tax law process, but when the president recommends a tax change, well, he has to go through a lot of channels. He has to get it, written up. He has to go through different task force throughout the Department of Treasury, different things like that, in order to get the law written up so that it can actually go through the House of Representatives and it can go through the Senate, and then it can ultimately be passed by the Congress. But what happens is once it's passed by the Congress, the president will actually sign off on it, or he has a chance to veto it. So, but here's the thing, he can sign off on it or he can veto it, but if he vetoes it, sometimes it can get overridden unless something else happens. So that's basically how the tax policy and tax laws change, is that it has to be passed by Congress. You can't say, listen, this is what's going to happen and this is it, so laws change right now. Well, no, that's not how it happens. So, and just know this, is that under the Trump and Biden policies, whichever policies there are, again, there has to be checks and balances. It has to be approved first. So yes, they're telling you all their wonderful plans for you, but we don't know if any of those can come to pass, because we don't know if it's going to be passed. We don't know if it's going to make it past the lobbyists or whatever it is. We just don't have any idea. So the best thing is to be definitely prepared. And so let me go over now. I feel as though that we're ready to talk about the different plans, because I wanted to really spend some time so you guys know what the tax laws are. And if you guys have any questions, feel free to put them in the chats, right? It's very important that you guys put them in the chat so that I can definitely read them, and we can definitely go from there. So under the Trump tax plan, so this is some of the things that he is proposing. Again, we don't know if any of this will come to pass on either side, but just know that these are their plans. And so for those who are businesses, for those that received the PPP loan and you guys got it forgiven and everything like that, there was another type of credit that happened, and that was payroll tax cuts. And so if you're a business, you have employees, just to sort of give you a little bit of a rundown about what happens with payroll taxes. For those who are employees, you guys know that there's a deduction on your paycheck, right? There's Social Security, there's Medicare. Those get deducted from your paycheck automatically in federal income tax, and you have your net check. Well, on the other side, the company has to match what got taken out of your check. So for instance, let's just say you made $100. Well, if they took out $15 for Social Security and Medicare, the company on top of that has to pay $15 in order to cover payroll taxes. And so what happens is that that there was, under the PPP forgiveness loan, all of that happened, there is a proposal. There was basically a credit of payroll tax cuts, basically. So the employee, and I don't know how many of you are actually taking it, but there were some companies that basically didn't have a deduction out of their payroll check and for it to be paid later. So let me sort of break it down. So that $15, So that $15 that's taken out of the employee's check, they left it in there, right? And so it won't get taken out until next year. And I think you guys probably saw an array of HR professionals and payroll professionals that were like, take it, don't let the company do that to you guys. Well, one of the things that Trump is proposing is for that to be forgiven, right? For the company and the employee to not have to pay back their payroll taxes that were taken out of their check, that wasn't taken out of their check. They're saying, listen, let's not worry about it. Let's forgive it. So that's one of the things that Trump is wanting to do. The next thing is reducing capital gains tax, right? Because a capital gains tax, again, if you guys heard, is long-term. You have to keep an asset for over a year. And so the capital gains tax is currently at 0%, 15%, and 20%. He wants to reduce that all the way down to 15%. So that would be the max rate of capital gains profit, capital gains income. So that's one of the things that he's saying. He's saying, listen, I can reduce it even 5% more. Another thing that under the Trump tax plan that he wants to do is just sort of seeing is to seek permanent status of the 2017 Tax Cuts and Jobs Act. He wants to make it a permanent thing. So the taxes as we know now, he wants to definitely make it a permanent thing because again, it is set to expire at the end of 2024, 25. And so we see that, you know, the corporate taxes and all that is low as 21%. Like that was a wow. That was a really big incentive for a lot of corporations because I mean, to save over 12, 13% as a corporation was really big. And you guys have probably heard how many people aren't able to, that haven't been able to pay taxes, those corporations, those businesses, right? How was Amazon able to get away with not paying taxes? How was Trump able, not to pay any taxes? And to really sort of see a little bit into the tax law, one of the things that is really beneficial that saves a lot of people tax money is I'll go ahead and give you these two things. So if you guys really want to listen about how these big companies are able to get away with paying zero tax or no taxes at all as corporations, one of the things that a business does is they have something called research and development, right? So the research and development cost. So under the research and development cost, those costs are like research, like Amazon. They have a bunch in research and development costs. Those are expenses, right? To research and to do some development of some of their products, of some of their software, of how they run the system, how they run their website. And so that's basically how they get away with paying Apple, all those tech companies, like they get a lot of cost reduction from research and development. The who they pay to research this type of thing, who they pay to develop new things, innovations, different things like that. And so there's a lot of credits associated with that as well too. And so that's how they're able to do it on the business side. Another thing on a personal side, you're like, well, how is Trump able to pay like $750 or however much that they paid in taxes? Is I'll tell you this, he's in real estate, right? He's able to take a deduction in depreciation. Depreciation is really big. So if you have commercial property, even if you have residential property, you are able to take a deduction in depreciation. And so depreciation is like a main thing that helps people save a lot in taxes. I've seen people in real estate like, yep, that's it. Like the people who knew why he wasn't able to pay a lot in taxes. And a lot of it was depreciation. Of course, there's consulting fees, there's coaching fees, continuing education fees, and different things like that. I think they said he paid consulting fees and it's like, hey, it's not fair. But again, hey, you are able to really get away from paying taxes. So that's some of the ways. That's some of the ways. And another of the ways that I would say that small businesses get away with, not get away, I'm not saying get away, but they're able to legally reduce their taxes is through, something called ordinary and necessary expenses for your business. Depending on your certain industry, there's certain deductions that you're able to take. Now, some people will get carried away and say, I can write off my whole house, I can write off, but if it's exclusively for business use, then yes, you can write off a portion of your home. That's normally a big tax break for a lot of people, just to sort of hone it down for you guys. But they're able to reduce their taxes on that. But real estate is a big thing, but there are a lot of losses that are realized in real estate. There's something else called a 1031 exchange. 1031 exchange is basically whenever I can buy a house property or a rental property or whatever it is, right? And I want to flip it. Let's say that I, sell it, I get the profits, and instead of recording that as capital, gains as taxes, right? Because I made a profit. If I'm able to flip, like buy another property, invest in another property within like 45 days or something like really soon, a similar property, then basically, I don't have to report the profits that I just made because I just took the profits and invested it into another property. So I'm not even I don't even have to do that. And so this is what I heard through the grapevine. And this is sort of segueing into the Biden tax plan is basically I heard that he wants to eliminate 1031 exchange to where I don't take the profit. I have to pay taxes on the profits that I make off of selling the house. Again, these are just proposals. These aren't truths and facts. Again, we don't know if this will even pass the Congress, right? Another thing that Biden would like to do is for C corporations. Again, 2017, it went down to 21%. Biden's wanting to take it back up to 28% because he's saying, hey, listen, corporations, they need a higher tax rate. So let's go ahead and up that tax rate, right? So up to 28%. So that's one of the things that he wants to do, 21% to 28%. So for those who don't have a C corporation, this really won't affect you. It will affect the bigger corporations. But again, they do have a lot of tax loopholes because they do provide jobs and stuff like that. Let's just be real. The government in general is going to be like, okay, let's see who's paying us or who we're paying, lobbyists. So that's one thing that just to know what lobbyists are. Lobbyists, the name that they get from that was, the representatives, if there was a representative that goes out and makes the laws, right? The legislative branch, there would be lobbyists or people who would wait out in the lobby in order for them to get out and sort of see what's actually going on, right? They would go and they would try to lobby for their particular interests. And so you have special interest groups for particular groups of people. You have oil and gas, you have service professionals, you may have real estate, you may have CPAs. There's different people that are wanting to lobby for their interest, right? And so, yes, some people are bipartisan. Listen, whoever wins, listen, I want to make sure that we're good on taxes. So that's a little bit about that as well, too. So another thing that's wanting to be imposed is that the capital gains rate. So if you guys remember, I was talking about the capital gains rates, right? Trump wants to take it from 20% to 15%. What Biden wants to do is he wants to expand it all the way to 39%. So he wants to increase it. He's like, listen, this little 15% type of business, no, right? So he wants to increase it to 39.6%. But here's the thing, y'all. This is for investment income that's over $1 million. So, some of you guys may have it, your investment income, do your thing. That's awesome. But yeah, so there's a little bit of increase that he wants to make there. Also, he wants to raise the income tax. So again, you guys can't see my slide, but the maximum, income tax rate went from 22%, 24%. And there were just bigger percents, right? And so here he wants to increase it to 39% tax rate for the very top high income earners. And so again, even if we were to go back, just to make sure, I mean, that's a 2% difference. So we have 32%, 35%, 37% if you're making over a half a million dollars. So over $500,000. And so with that, he's wanting to increase it to 39.6%, almost 40% of the top income tax rate. So that's about 2% for those making above $400,000. So overall, it would increase. And if I was making that much, that's a lot of money, honestly. That would be a lot of money. Like, ooh, either way, it's, you look at 37% all the way to 39%. But I mean, for the lower income tax rates, I mean, it could be higher, it could be lower. So you'll definitely have to look at that. But that's just basically what I've heard through that. Also, Biden was looking at imposing a 12% payroll tax on income above $400,000. Currently, there is a 12.4 payroll income tax for up to $137,000, right? So that's just FYI. I know that's a little bit deep, but let me not. So one of the other things, I say definitely one of the things that Biden wants to do is he wants to reestablish the first-time home buyers tax credit. The first-time home buyers tax credit. So he wants to reestablish that. One of the things that I've noticed, even the first-time home buyers tax credit, and I saw this with one of my clients, was that they received it in 2008, 2009. They first-time home buyers, they got a credit. It was great. But then a couple years later, they had to pay it back in increments every single year. So just know that, that's a possibility. That yes, you're taking a credit for now, but you don't know if you're going to have to pay that back. You don't know. That's why I said, even with the PPP loan and all of that, I mean, everything, it just sort of changed. First it was 8 weeks of payroll. You had to spend it within 8 weeks, but then it said, wait, let's stretch it out to 24 weeks. So it is ever changing. And the best thing that I can really tell you with any of this is that you really have to be prepared for all of it, right? You have to be prepared for, the ups and downs of the economy. You have to be prepared for the, political changes within the economy. And honestly, I'm putting out tax policies of Biden, of Trump, different things like that. But listen, if the mindset isn't right, it's going to be hard to really make it. And I know some people are like, that's why I'm voting for this person, or that's why I'm voting for that person. Well, I mean, it could have something to do with that, but if you're probably already going to have a bias towards one person or the other. And so, really, it's really not going to matter. The main thing is that everyone is responsible for their business's success. And I've seen companies make it through either administration, right? There's been both sides of the administration. And yes, they may whine about one or the other, but here's the thing. Even in the real estate industry, that the rate, like the return that you got from the commercial real estate industry, is constantly sort of been the same. There's a little bit of ups and downs through different administrations, but honestly, it came out to like a 7% return. So really, I mean, just looking at that, it really all is a different type of mindset, right? Like I said in the beginning, IRS is going to be taking money out of your paycheck, whoever gets elected. So please know that if you're still a W-2 employee, you're still going to get like money taken out of your paycheck. And so just FYI on that. Another thing that Biden would like to do, last thing, again, I wanted to keep this a little bit high level because I know that, it can be easy to get into the weeds, and you guys probably, see me and probably like, you already are in the weeds, right? Is he would like to expand the child tax credit to a maximum of $3,000. I think right now it's at $2,000. and then qualified expenses for dependent care expenses, all the way up from it's $5,000 now all the way up to $8,000. So there's different things that both of them would like to do in order to, I think, in order to, reduce the tax rate, reduce the amount of people that are paying taxes. But one thing that I can say is that, taxes are going to be paid regardless of what end of the spectrum that you're on. Taxes are going to be paid. So unless you are one of the people that know how to use some of the loopholes and some of the things to get out of paying taxes. And so one of the things that I'll talk about a little bit for those who are on here is that, the type of entity. I saw someone, hey, what's up, Lola J, talking about she is a disregarded entity, an LLC. Yeah, so an LLC is a disregarded entity. So what does that mean? That means, according to the IRS, it's a disregarded entity. What does that mean? You don't have to pay taxes on that income? No, that's totally not what it means. What it means is that depending on how your LLC is structured is how it's going to pass through, right? So let me talk about, as this is affecting businesses, the differences between a pass-through entity, right, and just a separate entity. So so when I talked about C corporation, a C corporation, you talk about Walmart, you talk about, so those corporations, those big corporations, the corporation itself has to pay its own taxes. Like Amazon, Walmart has to pay that 21% tax rate. So whenever it gives dividends or profits back to the owners, right? Dividends back to the people who own part of the shares, guess what? They get taxed as well too. So they get taxed for dividend income. So they call it double taxation because number one, you're getting taxed on the profits of that corporation. And number two, dividends are paid from the profits. And so the dividends are taxed on an individual level. So that's why they call it double taxation on a C corporation. Well, now you're talking about disregarded entity. Let's talk about LLCs. It's depending on how you're structured. You have a partnership, right? Your LLC could be a partnership. It can have multiple partners. You can have 10 partners within the LLC, right? So that means that it's going to be taxed as a partnership. If you're a sole owner, you're going to be taxed as a sole owner, as a Schedule C. What does that mean? That means a sole proprietor. That's right. That's what I'm talking about. So you're going to be taxed as a Schedule C. And so knowing these types of things is very important, that you are structured properly so that you can avoid paying taxes. And one thing that I'll say is that if you have passive income, right? That's why the IRS, they sort of see there are some tax advantages for those who have passive income. What's passive income? Well, rental, right? So rentals, that's what they call passive income, or even selling stocks. Those are passive income. What's the main tax advantage for that? For those who are on here, let me tell you what it is. It's the fact that if I have a Schedule C, business, if I'm over here making a side business or whatever it is, on that profit, I have to pay something called self-employment tax. Versus if I have passive income, I don't have to pay that 15%. And so that's the thing, right? That's the thing that you don't have to worry about, is an extra 15%, because your income is passive. It's passive. It's buying and selling stocks. It's buying and selling, real estate, right? It's passive income. And so again, you get to have depreciation. And so we have that passive income, and then we have that active income. And we see right here, we said Schedule C is combined business and personal income. So what happens is, just to be particular on words, it's pass-through income, right? So it's pass-through income. So whatever you make on your Schedule C. Now, here's what's an advantage of. So for those who are like, how do I get ahead of the game, right? So how you get ahead of the game is basically for those who have a side business and different things like that. I've seen people who have a W-2 income and then they have a side business. They either join a network marketing company, right? And, there's people who make money in network marketing and there's some people who don't. You have mileage, you have, if you use part of your home as an office, if you drive to different events and places and clients, you're able to take a lot of those deductions, and sometimes it comes out at a loss. Well, if it comes out at a loss, well, guess what? It can sort of go against what your W-2 income is. And so that's the thing. But however, one of the caveats to that is you don't want to be classified as a hobby, right? A hobby where you're not able to take some of your losses and apply it to your W-2 earned income. So you have to be careful with that. But there's a lot of people that actually do that. And for those who are in business, for those that are looking at how do I, reduce expenses? Well, I've done it for many of my clients who, were paying a lot, like massively a lot in taxes, and they have actually been able to reduce what they actually have owed, because it's just a simple change, right? You change the entity, you look at different deductions that you've missed. And so you have to really be careful about what's able to be deducted, what's able not to be deducted. And a lot of times I know people who ask friends, ask people, hey, this is how I do it, and you think that's the way you can do it. But you have to really be careful too, because of the ever-changing tax laws, because again, we're going through another change. Listen, next 4 or 5 years, there's going to be some tax laws we're seeing it right now. I mean, with COVID, that's actually happening. We've seen the PPP come into effect. I mean, we've seen so many things that happen with our taxes. And so what's the best way to prepare? Well, the best way to prepare is to actually do some tax planning, actually do some projections. Where do you want to be? And I don't know about this, for those who are listening too, is that you're able to have some tax deductions even within 401k, 401ks, investing in IRAs, or, different things like that. And then, so you have to sort of see, where do you see yourself in the future and what's going to help you within the future. Someone says, I use TurboTax. Yeah, that's what I'm talking about. So TurboTax, those things like that. I've actually had to help a few clients that use different tax softwares, because if you're not very keen on some of the tax laws, the questions can sort of lead you down a wrong path for sure. And so that's what I'm talking about. But yeah, you really got to be really careful just with Schedule C, Schedule E. That's for like rentals and royalties and different things like that. But to really have somebody who is knowledgeable within understanding taxes and understanding some of the laws and changes that are taking place. And so even within this next year, you can go to a lot of people, but there are people that are specialized in helping you plan for the future. So not only are you seeing, what's happening now, because here's something that I've seen that happen, is that, listen, you get your taxes prepared, right? Once you get your taxes prepared, it's like, okay, let's just say your business was booming and now you have a unexpected, let's just say a $20,000 taxes that you have to pay. And you're like, whoa, wait a minute. Why do I owe $20,000? And it took you by surprise. Well, that's because your income has gone up. You're like, well, can you reduce that? Well, here's the thing. We're only able to reduce legally about what's properly documented and what's properly accounted for. So if it's not accounted for, if it's not documented, then it's going to be hard for us to deduct legally some of those things that are, as deductions. And so it's very important that you have your tax documents in order. It's very important that you want to stay organized, but have somebody help you be on top of it so that you can start paying taxes, even estimated taxes, so you're not waiting or surprised at the end of the year having to pay so much in taxes. I mean, I don't know about you, but I don't know if any of you have been surprised financially. We're talking about a surprise bill, a surprise amount that you've had to pay, just surprises that come up, financially. And I can just tell you that I've been there, right? I understand what it means to be surprised. I understand what it means to find yourself in a hole. Because for me, I remember, I've been a CPA for over 10 years. And I remember, man, being in a financial hole and you're trying to climb out and you're trying to climb up. Here I am helping multi-million-dollar corporations and organizations. I'm helping them with their finances. But personally, for me, there was a limitation on my belief in what I can do. And so what happened for me is I was able to plan. I was able to get myself out of the hole so that I would be able to not be in that place again. And so let me see some of these comments. My house, yeah. I had a business tax account. Oh, yeah. I had big surprises one year when no estimated taxes. Yeah, so if you don't pay the estimated taxes, but nobody is there to help you to know what do I pay in estimated taxes, you think that your profits are the main thing that's going to hold you over. Well, those profits, if they come straight to you and you're not set up properly, then you're probably gonna have a big, tax. You're probably gonna have to pay a lot in taxes come tax time. And so, and there's penalties, there's interest that are added on there. So you want to make sure that to protect you and your business, that you have, the things in place so that you're not blindsided. You're not caught you're not caught by surprise and you're like, okay, where am I going to get this money from? And then next thing you know, your business is spiraling out of control because of low cash flow. And we know that businesses shut down because of no resources, low cash flow, right? And so to even help you to know, hey, listen, what do we need to do to increase the top line, but decrease the taxes, right? Decrease the taxes. What do I have to do? What are some things that I'm going to look at? Well, I do want to go ahead and definitely make this offer. I do have a course coming up. It's starting next week. It's really quick, but I'm not able to do it publicly. But if you want to send me an inbox, you definitely can, and I can give you information on the course. But it's to really help those business owners to know about their finances, right? What are the things to invest in? What are the things that I need to look out for? What are the different purposes of money? How do I multiply my money? How do I multiply the different things that I have, right? And I see right here, they don't take no loans for cash flow. But see, here's the thing. You'll be able to track where your cash flow is. You'll be able to track where your money is actually going. And so with this, it is a 4-week course. And also, just wanted to say this too, is that I am going to be open for tax preparation, tax planning, and tax consulting. So I am doing that. I've noticed that I've been doing it for free for some people. And so I'm like, okay, well, let's go ahead and turn that gift and make it into profit. I still will help people. Again, you guys have received loads and loads of value within this video. So if you take some of the things that I said and you figure out how to apply it, you'll be set. Like, I guarantee you will be set. You said, is this course for me? It could possibly be for you. If you want to go ahead, if you want to leave your email or something, I can go ahead and email you the link to the course and you can read through it. But yeah. If it's for you, then definitely. So I love it. So listen, we know that elections are happening tomorrow. And so again, what you want to do is you want to make sure that you're set up properly. And so whenever you have, let's just say if this season is a season of more than enough to where you have lots of money that is flowing in, then you may want to put some on reserve, right? You want to make sure to put some on reserve because we don't know what the next year is actually going to bring. And for those that are scraping to get out of the hole, what do I need to do? What do I need to do? This is the worst season. Think of some ways to really increase your income, your top line. You want to invest into things that will help increase your top line so that you can get some cash generating in your business. And so sales, cash, get those upfront customer payments. Look, I'm just giving away a whole ton of information. If you guys got any questions, please put it in the comments, tax rates and different things like that. But for those who want a W-2 listen, just go ahead and take advantage of, they did do the W-4 forms this year. So just know that, before where we had to put 1, 2, 3, we put a number in there. Well, now what we have to do is sort of estimate how much we'll have to owe in taxes, and that's what's going to be taken out of our paycheck. So a lot of employees are like, I'm not touching that. So they haven't updated it, and they don't even feel like updating it. So just FYI on that, you want to make sure. I did see, yes, I only have about 45 to 60 day cash reserves. It's super, super important, right? Okay, great. I love it. Someone says they do upfront money retainers. So yes, retainers are super, super important. So you want to do that. Listen, it's very, very helpful. So if there are no more questions, and Lola, I'll go ahead and I'll post the link on here so that you can see. And I appreciate you all. Listen, if you have any questions, listen, I know tomorrow y'all may be a little bit busy, but I can come back. Whoever is voted on, we can talk about what plans that they actually have. I can dig in a little bit deeper. It says if corporation taxes increase to 28%, what will actually change if they are going to deduct everything? That is a great question. Thank you so much, Dr. Keith Tolles, one of the fellow colleagues at Southern Nazarene University. One of the things that, you know what? I will tell you some of the things that will change. Nothing, right? Because it is based on the business. But I will say there is a big tax change that will happen within corporations. One thing that I can discuss is that towards the end of the Tax Cuts and Jobs Act, what they're wanting to do is, before with the research and development costs, you were able to expense that immediately, right? What's going to happen after that fades away, you're not able to deduct the whole thing anymore. So if I had research and development costs of, $2 million, well, I'm not able to deduct that anymore all in one setting. It has to be allocated out 5 years. So if it was $2 million, I'm not able to deduct that $2 million for the research and development cost. What I'm able to do is I have to break it out out of 5 years. So we're looking at $400,000 over the course of 5 years that can only be deducted. So R&D, yep, that's what they call it, R&D. So what will change? That may put a little bit of a change on some companies, but again, you'll see companies that take advantage of those, foreign tax credits, different things like that. But R&D, yeah, someone says right here is that if they invest into research and development costs, then their company is able to expand, provide more jobs, do different things like that. So it's a little bit of an incentive for them. Any other questions? This is really good. Like I said, I wanted to keep it high level for those who wanted to ask more detailed questions. Feel free, because I can definitely go into details, but to spare you some of the details, I didn't go in too deep, but yes, that would be some of the things that may possibly change. But there's always loopholes for the corporations, for the businesses out here. Hey, talking about you're from Asia. That's what I'm talking about. You already know I'm half Asian. So good to see you, Lola J. And any other questions on here? Even if you do ask a question, even if it's the replay, yes, I will respond to you. I will respond to that. And if it's a really good question, I'll come on a live again and I'll go ahead and I will respond. It says, how would a flat tax rate affect people rather than marginal scaling? Well, the thing is with flat tax rates, one of the things with flat tax rates is one of the things that could be good and bad in a particular sense is that people think a flat tax rate. If we just charge everyone, the corporations, I know their flat tax rate is 21%. So it affects bigger corporations and smaller corporations. So here's how it affects it. 21%. So in the past, the corporate tax rates went from 0% to 15% to 20% to 30% to 35%. So think about how it affected all of it. So I want you to sort of think about that. So the people, the corporations that were above the 20%, they have to pay 21% tax rate. They're jumping up and down. They're like, woo, all right, flat tax rate. This is so wonderful for me, right? Woohoo, no more marginal tax rates. That is a good thing for the bigger corporations that had to pay that higher tax rate. However, you think about the smaller corporations, right? The ones that in the past that had a marginal tax rates of 0%. They didn't have to pay no tax because they didn't make a lot of profit. Any profits that are made, 21% has to go to that. So that's bad for those smaller corporations. It's bad for the people that are, making the small amounts of money. So if we went to a flat tax rate in America and said, hey, listen, 22%, well, those that are making a lot more are like, woo, yes. They're seeing it as a good thing. But for those who aren't making enough, it's going to be a bad thing because they're saying, ooh, 20%. So that's like the main thing. That's how it's going to affect people, is because, and that's why they have marginal tax rates, because in a smaller percentages, you have the smaller rates, and then it goes up and up and up for those who are making more and more money. And so that's how it can actually affect it, is it probably won't be so well for the little man unless you had a flat tax for the little people. And here's the thing. Let me do it like this. So if it was 10% on $1,000, that's $100. But if it's like 10% on $1 million, that's $100,000. It's like, well, hey, that's a lot of money. Well, the thing is again, how the government sees it is, hey, listen, you guys, you making money in this country, we're going to take it. We want to take it, right? And so FYI on that, the way for corporations, and I know it's like, okay, well, they're not paying any income taxes. What's really happening? Well, they are paying Social Security and Medicare taxes. They are paying for different taxes in different states. They are paying, they're paying to sort of build up the economy. So it is like there is an expense for that. And so again, yes, it's going to definitely look different if you go to a flat rate tax system. Any other questions? I am open to any other questions. I'm just staying on here. Listen, we can do a Q&A. I love this. Someone says, hey, Lola J, that's what I'm talking about. 22% of 100K is different than 1 million. It says the same ratio, but different pictures altogether. And so, yes, there are different taxes that some people have to pay. Franchise tax, we haven't even gone into the state taxes, so you see some of the bigger money earners that move to Florida or Texas or something like that. They don't have to pay taxes, income taxes, but they may have a bigger rate of sales tax. They may have a bigger rate if they're a corporation. If you're a corporation, most states are going to want to get you. So they're going to have some taxes out in the other states. I know I said I wasn't going to go into state taxes. It says, if the tax rate is increased to 39%, do you foresee large and small businesses moving their operations abroad? So that's the thing. That's one of the things that I actually had read under the Biden tax policy. One of the things that that he wanted to do was he wanted to sort of bring some, sort of basically bring some jobs, keep the jobs here in America and have like a really good like tax credit. But there's tax credit if people move their operations abroad. And here's the thing. So if it increases to 39%, yes, businesses can move their operations abroad. But if there's a tax policy that can, if there's a tax policy that can limit that can limit the tax credits, then that can be, a situation of like, that can be a bad situation as well too. So either way, the government really wants their money. So yes, they can increase, that's probably not going to stop. Moving their operations abroad is probably not going to stop. And then it says, these are questions from my students. Hey, Thanks a lot. Shout out to you guys. Yes, I love it. Shout out to Group B180. Listen, they are in an MBA program, bettering themselves. Listen, Dr. Keith Tolles brought his whole class to broadcast, like to this broadcast. And so, yes, I have students watching me, and I love this. This is like my lane, my zone, because being a CPA for 10 years and being in education for almost 10 years is just super, super amazing. Listen, any of the other students that have any questions about how taxes can affect your business and can actually affect you, again, there's so many. I love it. Here's another thing. I wanted to go ahead and read this testimonial. Oh man, our company, I love this, and this is from Reginald Andre. He said, testimony, our company has used Janelle for the last year after being unsuccessful with 2 other firms. We are extremely happy with her. She is knowledgeable and put better process for us and always available. I highly recommend her. Never thought my CPA would be in another state, but it's working just fine. So listen, with Reginald Andre, listen, I mean, he has an amazing cybersecurity IT company. Listen, go check him out, especially if you're in a Miami area, because he will get you straight, first of all. But he is an expert, a cybersecurity expert. He has helped me as well, too, as far as really just knowing, cybersecurity on my phone, on my computer, owning your own business, because guess what? There's hackers everywhere that want to come in and get your information and get your money that would affect your money. So you want to make sure that you are following the right people that will help protect you in an event of cybersecurity. Because listen, if there's one thing that COVID is really like done, like, oh my goodness, it has definitely brought the tech industry, like it has grown the tech industry, but also as that grows, cybersecurity grows as well too. And so being secure. And so that's one thing. And so I love it. Reginald Andre, listen, his company is doing amazing. They're on like top 40. Every time I look into their company, it's either the CEO, the company, they're on like a top 40, top 10. They're in a top company. They're one of the top companies to follow. It's called Arc Solver. So you definitely want to check them out. And so, yes. So any other questions? I really, really appreciate everyone who has hopped on. I love Group B180. Man, they are so amazing. Man, I love it. I love it. I love it. Getting some practical tax information. I know the textbook, they sort of gloss over the information, but as far as like taxes, state taxes, how that affects, definitely need to know. Definitely need to know. And so any other questions? Any other questions? I love this. Thank you so much for the testimonial, Andre. He is super amazing. Really, really extremely humble. Really humble. Like that dude be making some moves. That dude's one of the masterminds. Like one of the people with like biggest masterminds that I have really met. Like, yeah. So any other questions? Some large companies are paying zero in taxes. What do you think needs to change so that the tax liability is fairer for small businesses? That is a really good question. Thanks for that question. Shout out again to the MBA group. Yes, B180. I love this. So there are a lot of things that need to change to make it fair for small businesses. But one of the things that I would definitely see what needs to change is some things that wouldn't really make bigger businesses happy. So let me just sort of pull back the curtain. Let's just be a little bit real when we talk about lobbyists, right? Lobbyists are those companies, right, that come to the politicians, that come to the House of Representatives, the senators, and they sit out in the lobby waiting for them to come out, because how it flows here is that we have the legislature law, and then it goes into, and then it passes through Congress. And so as they're lobbying, listen, it's the bigger corporations that have the money. I'm just telling you what happens on the back end. And so what would need to change, right? We know that there's probably some exchanges that are actually happening there, but what would actually like I said, that's, how can I say it? That is what's really benefiting the bigger companies, is the fact that they have the influence. Let me just say that they have the influence to go to the politicians, meaning money, right? They have the money to actually go towards the politicians and put money into their campaign to say, listen, this is what we want. That's just how the game is played. And I'm not saying it's shady. I'm not saying it's right. I'm not saying it's wrong or anything like that. But the only thing that I'm saying is that the things that may need to change is that one of the things that I will say that has changed is the QBI deduction. That means that there are qualified business income deductions. So whenever they saw that the corporations were, dropping all the way down a 21% flat tax rate, that's when the smaller corporations, the S Corps, the LLCs, all of them rose up and say, listen, I know you're not giving a big tax break and you're not giving us a big tax break. So what happened is they said, okay, let's go ahead and do the QBI deductions. And so that's the main thing that I'll say is that and there are some out there, the small business groups, SBA, all of that, really have to because the tax policies actually start with the House of Representatives, that start with the legislative branch. So you want to make sure that you affect those people so that they can go and they can petition the right law so that it can pass through Congress. Do you think an increase in taxes would result in an increase in goods and services for consumers? Let me sort of interpret that question the way that I'm receiving it. And if it's not that, you can go ahead and put it in of what you mean. Do you think an increase in taxes would result in an increase in goods and services for customers? So if we're talking about increase in taxes on business or increase in taxes on consumers. So let me go ahead and answer both. So it says, do you think an increase in taxes would result in business would result in good increase in goods and services? Well, there's two ways to look at it. So if I am a business and I have an increase in taxes, then I would say no, right? I have some people that I know. I'll just say that I have some people that I know that are very upset because they pay a bunch in taxes. And they're like, listen, the amount that I'm paying for taxes can go towards the people that I pay, the employees. They can go towards more increase in goods and services. So there's two ways to look at it. I think that a lot of business owners don't really want to pay taxes, right? Like they really don't. So what they're thinking is, if I have to pay an increase in taxes, then that money's not going towards goods and services because I'm worried about how much I have to pay in taxes. I have to worry about the increase in taxes. Well, I owe $10,000, $20,000, $30,000 in taxes. I don't know how I'm going to pay this, but it can motivate in another way too. So that means I have to increase in goods and services. That means that I have to sell more in order to pay the amount that I have in taxes. So I can see both ways where it can motivate a business, but it can sort of demotivate a business. And so a lot of businesses probably will say, hey, this is a demotivation factor. If I'm paying the amount of taxes, how am I going to be supplying jobs for companies and different things like that? Lola J says, listen, it says, I mean, small for profit, both businesses, nonprofit, reinvest profit for a charitable purpose. Yes, charity, that is one way as well too. Pay consultants. Yes. It says, do you think an increase in business tax liability would? Oh, yep. So that's what I just thought too. So business tax liability. Would increase in the prices of goods and services? I would say yes. I would say yes. If that person is able to see an increase in their prices, then I would say yes. But here's the thing, and I don't mean to go into a little bit of small business coaching. What happens is some of them are afraid to raise their prices. They're afraid to raise their prices, and so they keep them low so that they can be competitive. Well, what happens is if you try to stay low to be competitive, and I don't know if Reginald Andre's still on here, but he'll definitely tell you, if you try to stay low to be competitive, you're just going to be like a commodity. You're just going to be like everyone else. But if you raise your prices and you're able to differentiate yourself, become different from the rest of the market, people would be willing to pay more money because you're different. I mean, for example, think about Apple, right? Apple versus Android, that's just one of the things too. And so I won't go on that voting thing either, the whole Apple versus Android, whatever you guys choose, that's pretty cool. So that's one of the things that I would see, is that if they're bold enough to increase their prices, if they're not bold enough to really increase their prices, then what's going to happen is they're going to stay low. And so that's going to result in less cash flow, because they're having to pay the government. They're having, they're keeping the same amount of customers. So what do we do then? Well, the best thing to do is, that's when you really want to get someone who's great at tax planning, that can sort of look over the long-term taxes with you, help you hit your goals, help you hit, $1 million, $2 million, or however much that you need to make, but then also be able to pay your tax liabilities. Because here's the thing, just because there is an increase in tax liability, that doesn't necessarily mean that you've taken all the deductions that you've taken. That doesn't necessarily mean that, that you've actually, raised your price. But that's one of the best ways, though, is you want to create that margin. Listen, just for example, just to put things into perspective, you see people that are making 20, let me break it down to lower numbers. 5 million, right? They're making 5 million, but then they're only netting, $100,000, right? They're making big money, $5 million, but they're netting $100,000. Then you see a smaller company who's making maybe $500,000 and they're netting $100,000. It's just like, where's the margin, right? You're able to see what your profit margins are. And I feel like that those are important. And so, yes, I wish it would, but it's really dependent on the business. So to answer your question, class, MBA, awesome. Class, yes, that would all be dependent on the business owner. But I will tell you this, is a lot of business owners are afraid to increase their prices because they're afraid to make themselves different and raise their prices. That's one of the things. So I hope that answered your question. Yes. So that's what I've seen with different business owners. I know that some of you in the MBA program, those that are listening, you have your own business. And so it was probably nothing to you after you probably did get the tax liability. Like, listen, we're going to definitely raise these prices. And so reduce taxes by paying more tax deductible expenses. Yes, that is so true. You want to know where you're reinvesting your money in. You want to know where your ROI is coming from, your return on investment. So if you're putting your money towards expenses and not towards investing, well, investing ROI means you're getting money back from what you invested, right? I am a firm believer of paying those that will help you take your company to the next level. I'm a big proponent of that. I do that myself. And so any other questions? I love this. It says, I like, project-based versus retainers. It says you can reduce expenses. I'm reading comments from all different social media outlets. You can reduce expenses to net more. It says I have no overhead, work from home. Hey, that's what everyone's doing. I love it. No employees, subcontractors only, even me. I am not an employee. So in that case, if you have your own company, LLC, you can pay employees, but you can't pay yourself as an employee. You just have to get that profit, pay your self-employment tax, pay your income tax, and just do it like that. So any other questions? Any other questions? Let me go ahead and check on another page to see. Stop calling Android the smaller company. They're trying. I love it. They talked about Apple, 192 billion cash on hand. That's pretty fair. I mean, I don't know. Everybody who's listening, I'm pretty sure you guys wouldn't mind having 192 billion cash on hand. And Reginald Andre say, yes, do not be afraid to raise your prices. Everyone is doing it. Yes, everyone is doing it. Like I said, you want to differentiate yourself from that. Apple is superior. I love it. I hope it's not a full out war, right? from that. So are there any other questions? I really enjoyed this. I want to make sure to check on my outlets if there are any questions. Someone said no. So yes. So if there are not any more questions, I will go ahead and just let you guys know that yes. Okay, I saw someone said if tasks costs $125 per hour or more, then I do it. I do not hire any help. Right. So there's different things that you can do to increase your profit margins. Again, like I said, if you're in real estate, hey, depreciation has definitely helped a lot of people as well too. So one of the things that I noticed with small companies is the fact that they don't have any cash in their business bank account, but then they owe a lot of money in taxes, and they're like, "What happened?" Right? I don't understand. Yeah, there's a lot of things that can definitely attribute to that. If there's a lot of commingling with business and personal expenses and different things like that, it can sort of give you an impression that you have no money left profit from your business, but you actually profited. But there are some tax deductions that aren't actually deductible. So just an FYI on that. Hello, everyone who is just joining. My husband, awesome man. Even God likes Apple, or does he? I don't know, Derek, because he did take that. Adam took that bite. My husband did put up my website. The Profit Renovation is where my course is. The Coach Janelle CPA is just some information on there. And so, yes, let me know if you guys have any more question, and let me know, Coach Janelle for president for 2020. I think you meant 24, but 26. Hey, what's up? I'll go on a off years, right? So, all right. Well, God bless you all. And y'all are amazing. I just got a congratulations from Restream. I have received 100 messages today with Restream Trap. So thank y'all so much. Yes, 2024. Yes. And so just let me know. Thank you so much. Coach Janelle is the best in the world. Yes, y'all are the best. Thank you so much for listening. And like I said, if you guys have any questions, feel free to put them in the comments. And God bless and bye, you guys.